This is a quick video. This video is gonna just be a couple minutes to listen to Judge Ryder explain something that I believe to be untrue. It's about the tax abatement and one of the reasons why we need to grant it. So bear with me for just a second while I hit play. And this is from one of the last Commissioner Court meetings. It may have been the last one. You can view this video on the Centerville News on their Facebook page, at least for now, because I believe it was live streamed, and so it does have an expiration date and will delete at some point. But anyway, here we go. This is at the 1 hour and 58-minute mark.
Phrase pilot project. Can you tell me what you mean by pilot project?
Pilot stands for payment in lieu of taxes. We do that on the railroad now. Railroad pays us basically what they want to pay us instead of taxes.
Okay.
And so there's already stuff in place for things like that. But they agree, and the county agrees, and it's in writing of how much they're going to pay the county in lieu of taxes. Now, let me tell you why that's so important. I mean, why we think it's important. The state of Texas has limited us to 3.5% revenue per year to be able to give you the services that y'all expect and desire and have right now. 3.5%. Now, it's 5 to 6% a year. So you figure that out. That's going to eventually, anyway. This money that comes in on a pilot is 100% used by the county. It does not. It's not affected by the 3.5%. So that's raw revenue that we can spend on fire trucks or whatever we want to spend it on, in lieu of having to worry about doing the 3.5%. If we don't have the pilot, then the pilot rolls into the 3.5%. So you got a big difference of what you can actually have. Now, of course, this is a $15 billion deal. Sounds like a lot of money, but you doing 3% of last year's revenue, it's not just a whole lot. And so we're every year we're having to make sure we can do this. Now, state of Texas is also talking about a 1%, and even going down to a 0%. Now, zero, I'm not sure exactly how that works, but they're saying that every time on a zero, what I understand, every time we have a budget meeting during May, June, July, like that if we decide on a rate, then that rate has to go to the voters every time for a 2/3 majority to pass. If it doesn't, it reverts back to the last year, which last year is 3% less. And so what I'm telling you is that it's very difficult. First of all, an election will cost us about $20,000 every time we do an election. So that's unfunded mandate in my book. But so that's why we're talking about that, because it's raw revenue that we can use anywhere we want to use it, as opposed to the 3.5 that's just 3.5%.
So that's an incentive for you.
Okay. So what he left out there is, and this is something because that didn't sit well with me. That I don't know. I wasn't sure how that worked and stuff. And so what I've done is looked into what he said. And so what he said is, it is true. You can only raise the revenue by 3.5%, but that's on existing property, right? So if this data center was already here and it was already built, then we can't go raise the rate higher than 3.5%. But what he left out of this equation is something called NRR, or NNR, which is net new revenue. And so what he's talking about doesn't apply to net new revenue.